The key word in all here is deceleration. Earnings are decelerating. The companies continue to report really well, but all the outlooks continue to be very cautious. The economy continues to grow, but it's clearly that the best quarters of GDP growth are behind us. I think a lot of what investors should expect is go back to what is a typical late cycle where the liquidity goes down, interest rates continue to go up, and you continue to see a pickup in volatility as is normal in this part of the cycle. This is still a growth market, but it's transitioning to a more higher quality market, and that is again very typical of the end of the bull market cycle, which should expect the Fed to continue to look for opportunities to grow the economy, to try to maintain that, but at the same time being worried about the potential overheating of the economy.
And I do what as a result of that? And I do what as a result of that?
I think the big takeaway is stay diversified, look for opportunities, rebalance your portfolio, assess your risk. We have been in 7 years of low volatility. This is the time where the volatility regime has changed. I think reassessing your risk and understand and stay diversified is always a recipe for continued success.
So as they used to say on our midterms in college, discuss. Quincy, discuss what you just heard from Omar.
Well, clearly, we always say don't fight the Fed on the way down, when they're lowering rates. You don't fight the Fed. You're not writing white papers about it. You're investing and you go with the Fed. Clearly, on the way up, you've got to respect the Fed on the way up. And that means there's going to be more volatility. It means that we're in really uncharted territory because, remember, we were at zero interest rate policy. And the Fed is taking us out of a mindset that was buy on the dip, buy on the dip. And now you see what the market is saying, that dip better be much deeper before I even go in. So you've got to respect that until the Fed is finished and there's going to be more volatility. We're looking at a portfolio that already has manifested itself in the market. You're going to have more stocks in the defensive side, but also in a barbell strategy, you are going to be selective in technology. You're going to be selective in consumer discretionary. You're not going completely defensive, but you've already moved over. Now, I do want to point something out, and that is the credit market. The credit market has actually started to show signs of worry, not intense. It's not a red light, but that was last week. We're keeping our eye on it because if those spreads tighten now, it is constructive for the S&P 500. Normally what happens is the credit market gives you the first indication, and then the equity market is kind of late to get the memo on it. This time it was what's going on in the equity market bothering the credit market. We have to pay attention to that because if those spreads widen, it is going to be more difficult for this market to gain momentum.